You are listening to Golden Rule Radio, your weekly discussion of the precious metals markets and the markets closely associated with the metals. I'm Rob, alongside Tori and Miles. Now, each week, the three of us provide a technical analysis of the metals charts and cover underlying fundamentals and the news that helps move and predict the markets.
Starting out with gold. Gold up about 1.5%, like 1.3% from our recording last Wednesday. Currently sitting at $3,390. It's actually down a little bit the last couple days. It did get as high as $3,440.
Just this morning.
I guess it was just this morning. So, yeah, thanks. Yeah, well, technically that was earlier this week, so we can both be right. So a nice little bump up and then a bit of a decline here today on Tuesday as we're recording. Quickly moving over to silver. Silver's up 3.5%, sitting at $39.40 and continues to stair step up, trying to find out where it's going to take a break, maybe. We'll have to see. Platinum, checking on the other white metals. Platinum up another 1%, but that wasn't the whole story this week. So currently it's sitting at $1,445, but it did touch $1,500, giving us a new recent high, just like silver. And palladium up 3.6% to 1,335. So despite the big early lead by platinum, palladium is still only about $100 behind, and that is also putting in a new recent high this past Friday. Moving over to the paper markets, the S&P also up about 1.5% to 6,355, which is definitely a new high. And the US dollar is not at a new high. The dollar index down about 1.5% to 97.1. So everything's up, the dollar is down.
Which makes sense, right? That often tends to be the case. As the dollar declines, it's a weakening dollar. Prices adjust accordingly. Dollar down, gold up. But commodities in general, that's going to be the case.
Yeah, well, today's news on gold, it dropped $45 today. That's because they finally came up with a trade deal between the U.S. and Europe, tariff fixed at 15%. But that's really business as usual because there was a 10% plus another 4.8% tariff between the U.S. and Europe. So really nothing changed. I don't see why gold reacted the way it did, but I think tomorrow the market is going to be back up again. I don't think this is a trend.
I don't either. And that's on top of the Japan agreement as well this week with tariff agreements. And gold is staying so strong. The fact that we were north of 3,400, again, we just have not seen the seasonal or summer respite that we normally get. Like you said last week, Rob, we're probably not going to see it.
No.
Maybe we just are shifting a couple of months and we do get a little bit of a break because we've been preaching like buy these dips. And what's happened here, not only this week, but this is many weeks in a row that we've seen the gold to silver ratio tighten.
Yeah. We're at 86 to 1 right now.
Yes, 86 and coming off of 104.
Yeah.
And this is just this steady tightening. But that's because silver's up 35% year to date. So let's do a little bit deeper analysis here, Miles, than just the weekly recap, starting with the gold and the silver, because silver up 35% in 2025 is incredible.
Yeah.
Well, if you're going to keep hammering silver, we can go ahead and start there. But don't let me forget to come back to gold because there are a couple things I want to look at. So, silver. Yeah, guys, it went higher. I'll be honest. I was kind of, you got me on that one. I was kind of expecting silver to take a little bit of a breather. One of the big reasons that I was calling for that is when we're looking back at where the silver pricing was around like 2011 to 2013, when the bull market was running out of gas, but it hadn't really established a bear market yet. We were looking at tops down around 35, 60. And we definitely blew right through that number, and now we're up here closing in on $40. So the best I can do at this point, because we're really getting into that territory where we put in the all-time highs. This is where I have to bring out some trend lines. or extrapolate out where some Fibonacci retracements might end up, just saying what are some of the highs we could see silver get to where it may want to take a break. So Tori, I know you love when I do this. I'm going to throw out a prediction here. If silver continues, really, I don't see anything between here and about 42. So
that was the number I was going to say.
Perfect.
In fact, I was like, I don't want to say it because I'll probably be wrong. But yeah, that's right on.
Yeah. No, I like 42. 42 gives us some really nice retracement potential here. The 382 fib lines up, your 50% line, your 618 looks good. So that's probably where I'm going to be targeting here if silver is going to continue to climb. And the nice thing about that is if gold stays about where it is and we see silver get up to 42, well, that's another 5 or 6 points on the gold silver ratio that we're going to see it move down maybe to 80-ish.
The surprising thing about gold, I think if we look at the commitment of traders and if we look at inflows and outflows from GLD, I think that the U.S. market predicted a softening price for gold here in the summer months. And so they are exiting their positions. The inflows to GLD have not been there. And yet gold's holding steady. So the demand is coming from somewhere else.
Yeah, the ratio is tightening because silver is continuing to run, gold is holding steady. So as we expect to see this continuation of the silver climb, I think we're going to hit our head a few times on that $40 round number figure. Now, Miles always points out the news is certainly changing the timing of where we ultimately end up. And so we're one news event away or a lack of news away from getting to the 42. I would say 42 to 44, somewhere in that range. But I'm very optimistic with silver necessarily getting back to $50 at some point here because the depreciating dollar has caused all commodities, like even copper hit an all-time high, gold at an all-time high. Silver's not. Right.
Copper's still holding.
And platinum's not at an all-time high. Palladium had a recent one, but to me, it's a matter of, look, we still have a long ways to go to play catch up from a percentage run. We'll see that gold-silver ratio back into the 60s.
I'm thinking 50s. I'm thinking $65 silver within the next 12 months, with gold somewhere around $3,400-$3,500, unless we're one news event away from gold hitting 4,000.
Yeah, for a different piece of news, as a different reason, something major geopolitically or monetary policy or something else. But yes, silver is very, very exciting, and I like your guys' next target. I just think it's going to be tough to break through 40. If we hit our head there and it comes back down, buy those dips. I mean, just take that opportunity to save a couple percentage points as you add that to your portfolio, because this silver now is still going to end up equating to more gold later. Buy the silver now.
Yeah, and one closing thought on silver as we transition over to platinum and palladium. Just since April, up over 30%, and silver really hasn't gone parabolic unless we saw some sort of like bullish flag take off from here. Some really quick run up in silver and then have it flatten out for a period of time, flagpole and then into a flag. So we could see something like that happen, but if silver turned around right here and came back down a couple of bucks, most of that 33% movement in silver has stayed within a very defined and stable rising channel. So it can feel like a lot of movement in a short period of time, but it's not parabolic yet. So hold on to your hats with silver whenever it is, because we all know what happens when silver does finally get some legs. Now, talking about a flagpole, I figured that would be a good transition over to platinum. Platinum is certainly starting to run out of steam, at least on this most recent move, but the breakout move in platinum has been just incredible. I think we're up some 65-66% so far this year. Most of that movement starting in May, jumping up about a little over 50% since then. Platinum touching 1,500 this past week. Always nice to see a round number. Zeros do get people's attention. People tend to take profits or stop losses at double zeros. So I'd like to see platinum take a break, just like everyone else would, basically because I'd like the trolley to stop so I can maybe get on. That'd be kind of nice. Been wanting to increase my platinum position a little bit here, and despite the run up, I still think it's a good argument to do so. Platinum, I think, still, despite this growth, is just getting started, and this really is just an indication of things to come. It's still the most undervalued precious metal out there.
All right, well, let's move over to gold then. This is Golden Rule Radio, so let's keep our
Fair.
focus.
Yeah, Silver Rule Radio some days. And then, moving back to gold, we've been talking a lot about this pennant pattern concept for the last couple of weeks, the idea that you have a period of exuberance followed by either a pause or a reversal. A flag or a pennant is a pause. It's saying we've taken a step forward, we're going to take a break here. And gold's been on that
consolidation.
break now. Yeah. Exactly. Consolidation. That's a great word. So we've been having this break in the price of gold, and we've been building out this extended pennant pattern from a couple technical analysts that I follow. Anytime we get a little bit of a breakout of something, people start getting real excited to jump on it. I'm not quite there yet. What I would like to see with the price of gold is move above at least one of the previous highs, because yes, we did have a breakout above the pennant with a decline back down. And that goes back to the high we put in the middle of June. And then, of course, the previous all-time high back in April formed our top, and we had a little touch above it today. Personally, we could just be extending our pause, and I mentioned that last week. Gold has a tendency to trade sideways past the end of its pennant, past when those two lines sort of line up. It tends to stay within its trading range before you get the next big push up. It did the exact same thing on the downside. We put a floor in back in the middle of May, and then we broke below that pennant in June, but it's continued to move up. So all it's really done is extend it out. So keep an eye on gold, with silver still looking like it's not quite at the end of its bull market yet, that it might still have a couple bucks here to go before it eventually runs out of steam. It's certainly possible that gold could also be continuing up. I'm not in that camp yet. I still think gold is more likely to come down than up, but the down is going to be minimal.
Well, here's the thing, though. Gold in Asia is being restricted. The largest manufacturer and dealer in Japan is restricting access to their retail customers. It's also happened in South Korea. The bigger entities, central banks, etc., are bigfooting the available supply, it appears like. And the shift in perception in Asia has gone from gold being a hedge to gold being foundational. They're not just buying it because they're hedging some future risk. They're buying gold as a foundation. And the American investor is still sitting on their hands thinking, okay, well, when I'm ready, there's going to be plenty available, like right now. We've got everything you could want, and the premiums are ridiculously low. But that's changing in Asia, and the Asian market has been the primary driver of the gold price for the last several years. And lo and behold, Russia has opened up its St. Petersburg Gold Exchange. They're trying to offset the control of the LBMA out of London and the New York COMEX. You've got the Shanghai Exchange, the St. Petersburg Exchange now vying for dominance for price action and control of the gold market. And the American investor is still sitting on their hands. And I am encouraging our listeners to think of gold not just as a hedge, but as a foundation, because it's shifting around the world.
It really is. I mean, the whole world is looking at it and has looked at it as excellent collateral. In that regard, it operates as a hedge, but it's a cornerstone, really, of any portfolio. That collateral, though, like all collateral, makes its availability hierarchical. Central banks get the priority, then big institutional money. And
Right.
what they do is they suck up the large bars. Those get filled first. And what you're saying is that retail investor who's looking for the individual coins, that's not a competitive product with what those central banks and hedge funds and these large institutions are wanting. But at some point, it gets to the fact where everything gets sucked up. And unfortunately, those flexible investor programs like Tanaka ran, who you're speaking about, is an example of how a product gets sucked out of the market. They'll let you fulfill an order for dollars, but not for metal delivery. And that's a warning sign.
Yeah. And we're seeing it even in our market. We had hundreds of ounces of gold available today, and it's gone.
Yeah.
Gone.
Because of a certain demand for a particular product under a specific strategy that we follow. And that's an ounce or two at a time. It's not 100 ounces at a time. So we are the retail investor resource. So that's kind of what we're talking about. But the why is the fundamentals. Like, why is gold doing what it's doing? Why are the white metals doing what they're doing? And I'm going to start really from a why focus this week on the fundamentals with the Federal Reserve, because they're perpetuating the problem. They're the buyer of last resort of our debt. They're allowing the debt to go up exponentially. We've now crossed essentially 37 trillion in our debt. The debt is the main issue. It is the reason that gold is holding strong, as you point out, Rob. It's the reason that cryptocurrencies are in a bubble, because of our debt. And that's really not changing. I mean, just in the last 2 weeks since they raised the debt ceiling, we've added $441 billion to the debt in 2 weeks. And that's a looming debt crisis.
Well, and if you add up all the gold that we're supposed to have, all 8,100 tons, and mark it at 3,400 an ounce, that's only 900 billion. We burned through that in just a matter of weeks. Come on. We don't have enough gold here in the U.S. officially to do anything to offset the risk that we are facing.
We are not using it as collateral. But the Federal Reserve is fairly under a lot of pressure and scrutiny right now. I mean, obviously coming out of the mouth of President Trump, but his administration in general, and just saying, look, we need a review of the Federal Reserve. We've got to really do a deep analysis. Are they operating efficiently or not? Are they operating in reactive fashion or proactive? And that's the biggest complaint, is that they have got to start operating proactively rather than looking back at months old data and responding then.
Well, they're even throwing out the possibility that they're acting politically.
And there are arguments to be made, and there's proof to be pointed to that that's the case. And unfortunately, it's going to take a sea change to get that ship to start to turn around, because that has been the case. But there's a little bit of dissension amongst the troops at the Federal Reserve. And Governor Waller on Thursday night said there is a case for cutting right now. First of all, he said tariffs are a one-off increase in the price levels, and that they don't cause inflation beyond a temporary surge. So stop basing your interest rate policy off of a one-off event called a tariff. Secondly, there's a bunch of data that's saying that monetary policy should be close to neutral right now, not restrictive. Restrictive meaning higher interest rates. That's restrictive to the economy. The economy thrives on credit. So the lower the interest rates, the healthier the economy in a sense, or the hotter the economy, which can lead to inflation, which is climbing again.
Which is what they want.
They do and they don't. They don't want runaway inflation.
Well, the central bank doesn't, but the administration does.
That's correct. And that's a weak dollar policy, right? To cut rates and stimulate the economy.
Grow the economy, create revenue, try to grow our way out of a millstone that we've got hanging around our neck.
Well, and that millstone has not only been the stagflation that we've had, but it's the labor market. And now the labor market is kind of starting to struggle. It's near what he says is a stall speed. And so very importantly to the Trump administration, lower interest rates would also help drive a healthy labor market. Employment would be improved. So we'll see if his pressure is enough. Gold's had a lot of volatility because first there was a rumor last week that Trump was going to fire Powell, or said he was. And then he said, that's not what I said. And then yesterday there's a rumor that Powell resigned, and that was a social media fake. So you're able to move markets now with these lies and rumors. But anyway, Federal Reserve's a big one. The debt issue is a big one. The interest rates are crushing the housing market. That's just the case. But the M2 money supply, they're going to continue to print their way out of this. So if anybody's wondering, do I continue to buy gold? Yes, the debt issue is not going anywhere. Yeah. The money supply is at an all-time high, over $22 trillion for the first time ever. That is very, very negative news for the American consumer and citizen.
So while you guys were talking there, I did a little math, and looking at that, what was it, 8,300 tons, Rob?
8,100, yeah.
8,100. So you said worth math. About what?
Well, I took my boots off, yeah.
What was it again? 900 billion?
It's like 900 billion, yeah.
Okay, so you figure the government brings in about 5 trillion a year in tax revenue, which obviously they spend, and we know they spend all of it because they tack on another 2 to 4 trillion a year with inflation. So the government's spending, let's say, about 7 to 9 trillion a year. We've got 8 or 900 billion in gold. So that's what, about 11% of their annual spending. So I would argue that if you have about 11% of your annual spending in gold, you are just as fiscally responsible as the U.S. government.
I don't know. That's a place to start. Let's say that. Right. Yeah.
I mean, you have to figure out if you're the chicken or the pig when it comes to breakfast. The chicken's involved, but the pig's committed. And when I look at the gold market, I'm committed, okay? Because to me, it's foundational. It's not a hedge. It's the bedrock. It's the cornerstone of what we're about.
It is, because we operate on a fiat currency system where these currencies are not backed by anything.
No.
Right? I wish they were backed by eggs or bacon, but they're not backed by anything. And the debt issue isn't going anywhere. To increase it by $5 trillion in 2 years, that's not stopping. You guys, I mean, we will stimulate our way to economic viability and employment and trade advantage and all of that. It's not going to change. And the stock market is telling the same story. But unfortunately, the stock market concentration is terrible. The market cap weight of the top 10% largest U.S. stocks hit 76%. So the top 10% of U.S. stocks are responsible for 76% of the market
total
value.
market value.
Yeah, and that is a major bubble forming.
Yeah.
It's not a broad-based market.
No,
at all.
That's not indicative of a healthy economy. And a lot of people like to say, oh, the stock market's doing well, the economy must be hot. No, I don't like that. Whoever's in office, I hate that argument. To me, it's like with the fiat currency system we have, printing your way out of things, manipulating interest rates over time, Federal Reserve's obviously responding far too late. They've gotten political. All of that just means you just keep buying gold. To your point, Rob, it's the cornerstone.
Well, it just shows what people are committed to, because the only reason that would be the case is because people have been funneling their more broad-based portfolios towards the smaller, larger number of stocks, either chasing the gains or concerned with broader, smaller, mid-cap company fall off in the equity price. So in the United States,
Or they're looking at cryptos, Miles, and the question
that's true
that
too.
Kevin Orr consistently asks is your motivation to own a crypto is because you think you're going to make more money?
Yeah.
That's it. It's
Is there a
speculative
reason
investment.
for owning it other than just making money? No.
So here in the Western world, we're pretty heavily committing into the paper market that we've been fixated on for a long time. But you go overseas, you go to Europe, you go to Russia, you go to Asia. The Tanaka Precious Metals News, like, this isn't a gold dealer. This is the gold dealer.
The gold dealer.
They're the largest refiner in Japan. So they're not just the largest dealer in Japan, they're also the largest refinery in Japan. So for them to say, we don't have the supply to meet increasing demand on a retail level, and we're limiting the amount of money that you can pull out of your gold accounts, we'll give you your cash back.
Yeah, not the money.
Yeah,
Yeah.
sorry, I said money. We'll give you the cash back. Well, gold is money, cash is paper.
That's right.
So, yeah, once again, I'm right, as per usual.
And I want our listeners to understand those restrictions to access what you think you want when you're ready to buy, that's going to happen here in the U.S.
You take the global sovereign bank gold holding going from 9% to over 25% in a very short period of time.
Yeah.
This is going to trickle its way down into the retail market as prices go higher. People are going to find out gold is not in infinite supply. In fact, that's kind of the point of owning it. So we are just now starting to see this work its way into the retail market. It's going to start in Asia. It'll move into Europe. And eventually when gold is 5 or 10 or 50,000 an ounce, the average American is finally going to catch on at that point because
I hope not.
That's how it tends to work.
Miles, it's funny you say that too, because that's what's happening in the stock market.
Sure.
Over 20% of the trading volume has come from mom and pop investor share. It is the retail investor in the stock market, and they're always late to the game. The stock market's at all-time highs, and over the last 3 months, they have bought more stock than ever. As the stock market's been at an all-time high.
Can't
And here's
lose.
gold, not at an all-time high, relative value, not even close. Silver certainly not close to the all-time high. And yet the retail investor is going to be late to the game there. They're going to jump in after it's gone manic, after it's gone parabolic, which we haven't seen yet, but it's after the flagpole, unfortunately. And it's like, you've got to change your mindset. These things cycle, and it goes from stocks to gold and stocks to gold, and oftentimes stocks to commodities in general. Stocks to commodities, they take turns. This is the time to be buying the commodities when the retail interest isn't there.
You can take a bag of junk silver, 715 ounces. It's less per ounce than a 1,000-ounce bar. And then we're going to get to a point where you can trade that 715-ounce bag of junk silver for a 1,000-ounce bar. Who wouldn't want to do that? You can buy proof gold American Eagles right now for less money than you can directly from the mint, by about $400 an ounce less than buying it direct from the mint. I mean, right now you can buy proof Eagles for 1% to 2% more than a gold Eagle.
And turn around and make a 30% gain in gold Eagles later. Who wouldn't want to do that?
Who wouldn't want to do that? There's great opportunity in this market.
Well, that's going to do it this week for Golden Rule Radio. If you liked what you heard, head on over to our website to find additional info. That's McAlvany.com, McAlvany.com. And as always, if you'd like to discuss your personal portfolio with one of the advisors here at McAlvany Precious Metals, you can reach us at 1-800-525-9556.